The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed?
The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation. The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate.
The Fed also includes 12 regional Federal Reserve banks located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather economic information from all over the country
To help the Fed both monitor the economy and get the broad input necessary
To develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy,
which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
By making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and to communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress on vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen. Real GDP rose at a robust 6.4% pace in the first half of the year, and growth is widely expected to continue at a strong pace in the second half. The sectors most adversely affected by the pandemic have improved in recent months, but the rise in COVID-19 cases has slowed their recovery. Household spending rose at an especially rapid pace over the first half of the year, but flattened out in July and August as spending softened in COVID-sensitive sectors, such as travel and restaurants. Additionally, in some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production. Partly reflecting the effects of the virus and supply constraints, forecasts from FOMC participants for economic growth this year have been revised somewhat lower since our June summary of economic projections, but participants still foresee rapid growth. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and job gains averaged 750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The unemployment rate was 5.2% in August, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth. These factors should diminish with progress on containing the virus, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.8% at the end of this year and 3.5% in 2023 and 24. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year. While these supply effects are prominent for now, they will abate, and as they do, inflation is expected to drop back toward our longer-run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and longer lasting than anticipated, posing upside risks to inflation. Our framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. The path of the economy continues to depend on the course of the virus, and risks to the economic outlook remain. The Delta variant has led to significant increases in COVID-19 cases, resulting in significant hardship and loss, and slowing the economic recovery. Continued progress on vaccinations would help contain the virus and support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. Even after our balance sheet stops expanding, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Half of FOMC participants forecast that these favorable economic conditions will be fulfilled by the end of next year. As a result, the median projection for the appropriate level of the federal funds rate lies slightly above the effective lower bound in 2022. Participants generally expect a gradual pace of policy firming that would leave the level of the federal funds rate below estimates of its longer run level through 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. More important than any forecast is the fact that policy will remain accommodative until we have achieved our maximum employment and price stability goals. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you, and I look forward to your questions.
Thank you. We'll go first to Rachel Siegel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. When it comes to the taper and eventually to any rate increases, I'm wondering if you can walk us through what substantial further progress looks like given the latest batch of projections that have PCE inflation coming in a little higher than the June projection, the unemployment rate also being higher than June, as well as the change to GDP lower than June. If you could help us make sense of all those things as you sort through what substantial further progress looks like, that would be great.
Sure. So the test for beginning our taper is that we've achieved substantial further progress toward our goals of inflation and maximum employment. And for inflation, we appear to have achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of many others. So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December when we articulated the test and the readings today, in many cases more than half of the distance, for example, between the unemployment rate in December of 2020 and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting, that's the purpose of that language, is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
Thank you. We'll go to Howard Schneider.
Thanks, Chair Powell. Thanks, Michelle. So looking at the SEPs, we got now basically 4 years of inflation above target, and policy never gets to the long run rate. I'm wondering if you could address that from two perspectives. One, within the new framework that the Fed adopted last year. And second, from the perspective of the average household that's now being asked to pay higher prices and increasingly higher prices for 4 years running, when for some this year, real wages have actually gone down.
Sure. So as you can see, the inflation forecasts have moved up a bit in the out years. And that's really, I think, a reflection of, and they've moved up significantly for this year, and that's, I think, a reflection of the fact that the bottlenecks and shortages that we're seeing in the economy have really not begun to abate in a meaningful way yet. So those seem to be going to be with us at least for a few more months and perhaps into next year. So that suggests that inflation is going to be higher this year, and a number, I guess the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Those are very modest overshoots. You're looking at 2.2 and 2.1, 2 years and 3 years out. These are very, very. I don't think that households are going to notice a couple of tenths of an overshoot. That just happens to be people's forecasts. We want to foster a strong labor market, and we want to foster inflation averaging 2% over time. And I think we're very much on track to achieve those things. In terms of the framework, I see this as very consistent with the framework. We want inflation expectations to be anchored at around 2%. That's really the ultimate test of whether we're getting this done under the framework. And we do want inflation to run moderately above 2%. I wouldn't put too much on a couple of tenths over 2% in 2023 and 24, 1 tenth in 24. But you're right; those are the numbers.
Thank you. Let's go to Colby Smith.
Chair Powell, thank you, Michelle. Chair Powell, you mentioned ongoing discussions about the tapering timeline, and I'm wondering what the contours of that debate have been. For those that want to move a bit more quickly, is it about maintaining optionality for a 2022 interest rate increase, or is it about financial stability risks or concerns about the efficacy of asset purchases at a time when we have supply constraints? Thank you.
So let me say that there's very broad support on the committee for this plan, both as to the timing and as to the pace of the taper. So this was a unanimous vote today, and I'd say quite broad support for this approach. You're correct that there are some who would prefer to have gone sooner, and they've made their arguments publicly. For some of them, it's a financial stability concern, and for others, it's other concerns. They can make their own arguments. This is an approach that the committee will broadly support, and it will put us, having completed our taper sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then, as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning. And of course, this leaves the whole question of rate increases ahead, which is really where the framework is all about, how we deal with rate increases and that sort of thing. So we think this is the appropriate way to go, and again, broad support on the committee.
Thank you. We'll go to Nick Timrose.
Hi, Nick Timrose of the Wall Street Journal. Chair Powell, you have said the test for liftoff is more stringent than the test for tapering. But if the near-term projections today are credible, more of your colleagues seem to think that rate liftoff and not just a taper may be closer at hand. Does the committee have a different opinion than you do about the threshold for liftoff that you've articulated, or do they believe that either inflation or economic growth will necessitate a rate increase sooner than you do?
Well, so again, substantial further progress toward our goals is the test for beginning the taper. And the taper takes some months in everyone's figuring. So you're going to be well away from satisfying the liftoff test when we begin the taper. So in terms of the liftoff test, though, it's what we adopted last September. It's labor market conditions consistent with maximum employment. And while we have interesting signs that in many ways the labor market's very tight, we also have lots of slack in the labor market, and we think that those imbalances will sort themselves out. Inflation at 2% and on track to achieve moderately higher inflation over 2%, that really depends on the path of inflation. If inflation remains higher during the course of 2022, then we may already have met that test by the time we reach liftoff. So I just think if you look at what people are writing down for year-end 2022 numbers, some people are writing down very low unemployment rates, and that's only one indicator, but it suggests a very strong labor market. And I think they're writing down in good faith what they see as meeting the test. There's a range of perspectives about where the economy will be, but by the way, all but one participants have us lifting off during 2023. So it's not really an unusually wide array of views about this.
Thank you.
We'll go to Gina Smialik.
Hey, Chair Powell. Thank you for taking our questions. Prior to recent media reports, were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year? And I wonder if you thought those were appropriate.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand very well that the trust of the American people is essential for us to effectively carry out our mission. And that's why I directed the Fed to begin a comprehensive review of the ethics rules around permissible financial holdings and activity by Fed officials. So those rules are in many respects the same as those for government agencies, plus a number of things that apply specifically to us because of our business. One of those is sort of three things I would point to in terms of specific restrictions. One is ownership of certain assets is not allowed, and that's bank securities and other things. Secondly, there are times when we're not allowed to trade at all or to buy and sell financial assets, and that's the period immediately before and during an FOMC meeting. And third, there's regular disclosure. So all of these, everyone's ownership and activities are all disclosed on an annual basis. So I would have had to go back and read people's financial disclosures to know what their activities have been. This has been our framework for a long time. And I guess you'd say it's served us well. The other thing you would say, that it is now clearly seen as not adequate to the task of really sustaining the public's trust in us. We need to make changes, and we're going to do that as a consequence of this. This will be a thoroughgoing and comprehensive review. We're going to gather all the facts and look at ways to further tighten our rules and standards.
Great, thank you. We'll go to Steve Leisman.
Thank you. Thank you, Mr. Chairman. I want to follow up on Gene's question. The issue of ownership of these stocks and trades, do you think it's appropriate for Federal Reserve officials to be owning the same assets that the Federal Reserve is buying? Is that one of the modifications that you're looking at? And in that, you said yourself they don't clearly not seen as appropriate. In that, the Fed's code of conduct says Fed officials should avoid even the appearance of conflict. Do those trades, in fact, and holdings violate the Fed's code of conduct? Finally, do you have a timeline as to when you might be done with your review? Thank you, sir.
Don't have a timeline yet. We can start with that. Well, let me address the muni question, since that's in there. I personally owned municipal securities for many years, and in 2019 I froze that, meaning I'm holding all those securities, my wife and I, to maturity, and munis were always thought to be a pretty safe place for a Fed person to invest, because as you know, the lore was that the Fed would never buy municipal securities, so it was not an uncommon thing. And so then comes the COVID crisis, and I reversed that policy, and I did it without hesitating. And the reason was that the financial markets, and including the municipal financial market, were very much on the verge of collapse, and it was time to go, and we did. But we also checked with the Office of Government Ethics, who looked carefully at it and said that I didn't have a conflict. So that's one answer that I wanted to share with you. Secondly, you're right, though. We're going to be looking at all of those things. I don't want to get ahead of the process here and speculate about particular outcomes. But this, again, comprehensive and deliberate process. We're going to make changes. I want to be able to look back on this years from now and know that we rose to meet this challenge and handled the situation well, and that what we did made a lot of sense and protected the public's interest and the institution that we're all a part of.
I'm sorry, Chair Powell, I just want to follow up. You said I was right when you said right about that the Federal Reserve Fed should not own the same assets they're buying? Is that what
I think that's a reasonable thing. Yeah, and of course, for the most part, we don't. I mean, it was a real coincidence. I happened to pre-own these munis. They were bought many years ago, actually, and so we started buying munis as part of the municipal liquidity facility. So it was really it just was an unforeseen event, and I couldn't sell them. So what I did was I just held them, checked with the ethics people, and went ahead. So, but as a general principle, yeah, that makes a lot of sense.
Thank you.
Thank you. We'll go to Chris Rugaber.
Thank you. Thank you, Chair Powell. Well, I had a question about jobs and the Fed's schedule, the Fed's policy framework you laid out here. You and other Fed officials have often talked about expecting a job market pickup in September as more children return to school, freeing up more parents to work, COVID abating. You mentioned in the past the extra unemployment benefits expiring. There's some real-time data suggesting that we may not be seeing much of a return of labor supply. So do you still expect to see that in the next couple of jobs reports? And how would a relatively weak jobs report in September affect your plans? Thank you.
So you're right. We have I'll call it a unique situation where by many measures the labor market is tight, and 11 million job openings, very widespread reports from employers all over the economy saying it's quite difficult to hire people, wages moving up, and that kind of, so quite a tight labor market. So our view, I think a widespread view a few months ago, was that several things were coming together in the fall, including kids back to school, which would lighten caregiving duties, including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply. And so we'd get out of this strange world where there are lots of unemployed people and a high unemployment rate, but a labor shortage. And so what happened was Delta happened, and you have this very sharp spike in Delta cases, and I think so that affects, for example, when schools are open 60% of the time, or when they're always at a threat of being closed because of the Delta variant, you might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened. Also, people didn't, as you know, hiring and spending in these face-to-face service industries, travel and leisure, it just kind of stopped during those months. So that really the big shortfall in jobs was largely in travel and leisure, and that's clearly because of Delta. So that all happened. And so what we know is that it didn't happen. I think there's still, it may just be that it's going to take more time, but it still seems that inexorably these are people who were largely working back in February of 2020. They'll get back to work when it's time to do that. It just may take longer time. You're right, though, it didn't happen with any force in September, and a lot of that was Delta. In terms of you asked also about the test for November. I think if the economy continues to progress broadly in line with expectations, then I think, also the overall situation is appropriate for this, then I think we could easily move ahead at the next meeting, or not, depending on whether we feel like those tests are met.
Well, if I just quickly follow up, I mean, how much of that will depend on what kind of jobs report we get for September? And I mean, is it, are you in a data-dependent phase here where you need to see certain numbers going ahead, or are we at a point where you've accumulated enough progress that?
So it's accumulated progress. So for me, it wouldn't take a knockout, great, super strong employment report. It would take a reasonably good employment report for me to feel like that test is met. And others on the committee, many on the committee feel that the test is already met. Others want to see more progress, and we'll work it out as we go. But I would say that in my own thinking, the test is all but met. So I don't personally need to see a very strong employment report, but I'd like to see a decent employment report. I mean, it's not to be confused with the test for liftoff, which is so much higher.
Great, thank you.
Okay, thank you. We'll go to Victoria Guida.
Hi, Chair Powell. So I wanted to ask about the Vice Chair of Supervision position, and I was wondering if you could speak about how you view that role and the extent to which you defer to that person on regulatory policy. And then just sort of a related question, as you know, Randy Quarles' vice chairmanship ends next month, and I was wondering if he's going to retain the supervisory portfolio until he's replaced in that role.
Sure. So Dodd-Frank created this position, Vice Chair for Supervision, and there's actually a specific assignment in the Dodd-Frank language, as I'm sure you know. And effectively, what it means is that the Vice Chair for Supervision is charged with setting the regulatory agenda, and it's a specific grant of authority. And in the 10 years almost that I've been at the Fed, that person has really done that. Dan Tarullo certainly did it, and Vice Chair Quarles did it as well. And I think I respect that authority. I respect that. That's the person who will set the regulatory agenda going forward, and I would accept that. And furthermore, it's fully appropriate to look at for a new person to come in and look at the current state of regulation and supervision and suggest appropriate changes, and I welcome that. In terms of Vice Chair Quarles' term, we're not currently in that situation, and I actually don't have any updates for you on that today. We'll keep you posted on that.
Thank you. We'll go to Steve Matthews at Bloomberg.
Thank you. Chair Powell, I wanted to ask about the inclusive monetary policy framework. In particular, Bloomberg surveyed economists, and we found that they predict liftoff will happen when the U.S. unemployment rate is 3.8%, but the black unemployment rate is 6.1%. And I'm wondering if a 6.1% unemployment rate for African Americans is consistent with full employment, or whether it would need to be lower as part of your inclusive growth strategy.
Right. So the point of the broad and inclusive goal was not to target a particular unemployment rate for any particular group. Really, we look at a broad range of a very broad range of metrics when we think about what maximum employment is. And one of the things we look at is unemployment rates and participation rates and wages for different demographic and age groups and that kind of thing. So we will do all of that. So I think if you look back, what were we really thinking? So we all saw the benefits of a strong labor market. If you look at the last 2 or 3 years of before the pandemic hit, you saw, after a lot of long progress, you saw a really strong labor market, and you saw wages at the low end moving up faster than everywhere else, something that's great to see. We also saw the lowest unemployment rates for minorities of various, for African Americans, for example, and also participation rates. I mean, we saw a really, really healthy set of dynamics. And by the way, there was no reason why it couldn't continue. There were no imbalances in the economy, and then along came the pandemic. There was nothing in the economy that looked like a buildup of imbalances that could cause a recession. So I was very much thinking that the country would really benefit from a few more years of this. It would have been great. So we're all quite eager to get back to that. We also said we wouldn't raise rates just in response to very low unemployment in the absence of inflation. So that was another aspect of it, because we saw that really benefited labor market participants in a broad and inclusive way. That's, of course, not the current situation. We have significant slack in the economy and inflation well above target, not moderately above target. So that's really how we think about it. It isn't really just targeting the headline numbers, but it's about taking all of those things into account in your thinking about what constitutes maximum employment.
I guess just to follow up, should there be a significant gap between black unemployment and overall unemployment for structural reasons that are outside of the control of the Fed that other people should be doing something about, or should the gap be narrowed, if not down to zero?
Well, first of all, ideally there wouldn't be any gap, of course. We would all love to see no such gap. This is a persistent gap, and it's very hard to explain based on typical metrics. It's quite troubling, but it really is. We have famously broad and blunt tools. I think eliminating inequality and racial discrimination and racial disparities and that kind of thing is really something that fiscal policy and other policies, frankly, education policies and that kind of thing, are better at focusing on. I think we've identified the part that we can do, and we'll do that part. But I've always been clear that it's going to take policies broadly across society to work on these problems.
Thanks.
Thank you. Let's go to Michael McKee.
A plan for dealing with a debt default that included prioritization, that included changes in bank regulations, and possibly selling defaulted or non-defaulted treasuries and buying those who are that are. Are any of all of those still on the table? Do you think any of those would work? And what would happen to the economy, in your view, should the debt ceiling not be raised?
So I missed the first few words, but I think I got your question. So it's just very important that the debt ceiling be raised in a timely fashion so that the United States can pay its bills when and as they come due. That's a critically important thing. The failure to do that is something that could result in severe reactions, severe damage to the economy and to the financial markets, and it's just not something that we could contemplate, that we should contemplate. I'm not going to comment on particular tactics or things like that. I'm just going to say that I think we can all agree that the United States shouldn't default on any of its obligations, should pay them when and as due, and that no one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those. That's when they're due.
If I could follow up, have you discussed options with members of Congress?
I don't generally ever talk about the conversations I have with elected officials or other appointed officials. But look, you can see that this is a major focus among those who have responsibility for it, and including elected people.
Thank you. Let's go to Hannah Lang.
Hi, thanks so much. Senator Warren sent you a letter last week urging the Fed to break up Wells Fargo, citing what she called ungovernable behavior from the bank. I was just curious, under what circumstances would the Fed actually consider revoking a financial holding company's license, and if the indiscretions at Wells Fargo, in your opinion, warrant such an action?
Right, so we're, of course, very closely monitoring Wells Fargo's efforts to fix its widespread and pervasive problems. They represent a serious matter to us, and the firm is required to remediate them. And we will take appropriate supervisory action if the firm fails to meet our expectation. We continue to hold the firm accountable for its deficiencies with an unprecedented asset cap that will stay in place until the firm has comprehensively fixed its problems. We're not going to remove that asset cap until that's done. Bottom line is we'll take strong supervisory action if a firm is engaging in unsafe and unsound practices or violating laws, but I can't speak to our confidential supervisory assessments of any individual bank.
Thank you. Now we'll go to Michael Derby.
Thank you for taking my question. You noted earlier in the press conference that you weren't aware of the trading activity of the Boston and Dallas Fed bank presidents. As you know, all 12 regional Fed bank presidents just went through the renomination process earlier this year, and Governor Brainerd described it as a rigorous process at the time. So I want to know, did anybody at the board level know about the stock trading activity? And going forward, do you still have confidence in the Dallas and Boston Fed bank presidents to do their job?
So these, I don't need to tell you, people file these reports annually, and I think they were just quite recently filed for 2020. So I don't have any reason to think people at the board would have known about particular trading that's going on. They will see that. There are people at the Fed who see that. See the trading reports when they're annually filed. In terms of having confidence in that sort of thing, I think no one is happy. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is an important moment for the Fed, and I'm determined that we will rise to the moment and handle it in ways that will stand up over time. I'm very reluctant to get ahead of the process and speculate, though, about different things. And when we have things to announce, we'll go ahead and do that. But that's really what I have for today.
So one small follow-up. I mean, I know that you didn't have the 2020 forms in hand, but you would have had past year forms in hand, and at least in the case of like the Dallas disclosure forms, similar trading activity was shown in years past. So that in theory could have been something that came up in the renomination process.
So that's a good question. So, the 5-year review that we do under this unusual provision of law where all of the Reserve Bank presidents are reviewed for reappointment at the same time every 5 years, that is really a broad review about their leadership of the institution, their performance on the FOMC, all of those things. And if there were a concern, a public concern or a private concern about something that someone had done, we wouldn't wait for the 5-year, we wouldn't wait that day if there were concerns. You're right, though. These, as I mentioned, we have had a framework for a long time, and it's similar to what other government agencies have, only it's a little stricter. And it is that you can trade financial instruments, but not specific ones like bank debt. You can't trade during the FOMC period and during the meeting, the blackout period, and then during the meeting. And then you disclose all this. And we have disclosed it for years. So all of these things have been going, to the extent they've been going on, they've been a matter of public record. And, but nonetheless, so that, it was seeming to work just okay. And now you look at it and you see this and you think, we need to do better, and we will. But you're right, but it has not been part of the process, and appropriately, I don't think it should have been. I mean, I wouldn't blame the people who conduct that review. I really think if someone had raised concerns or if we'd had concerns, than it would have been, but it wouldn't have been part of that process. It would have been raised instantly rather than once every 5 years.
Thank you.
Thank you. Let's go to Jean Young.
Thank you, Michelle. Chair Powell, I wanted to ask about how the Fed would balance the two parts of its dual mandate. If inflation stays elevated, but we still have a labor shortage and participation remains lower than ideal, would you hold off on raising rates, or how would you think about that? Thank you.
Well, let me say one thing. You're looking for conditions consistent with maximum employment to lift off, and those conditions can change over time. So you're not necessarily bound by a particular level of the unemployment rate or the participation rate or anything else like that, which can change over time. But more to your point, really, we actually have a paragraph in our framework, and something like this has been there for a long time. I think it's paragraph 6. And you're talking about a situation in which the two goals are not complementary. They're somehow in tension. And if we judge that is the case, what it says is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with mandate. So we used to call that the balanced approach paragraph because it had those words. So it's a very difficult situation for any central bank to be, to be in a situation where the two goals are in tension. And that paragraph tries to address it by saying we would sort of weigh the equities between the two, how long will it take and how big are the gaps and that kind of thing. We don't really think we're in that, we're sort of in that situation, I'd say, in a short-term way. But we think, we do expect that, that this is sort of because of the COVID shock and the reopening and all that, you're seeing this temporarily.
Great. Thank you. We'll go to Edward Lawrence.
Thank you, Michelle. Thank you, Mr. Chairman, for taking the question. So on corporate debt, what happened with Evergrande that we've been watching, is that a preview of what could happen with the amount of corporate debt that's out there? In the past, you said you're watching the level of corporate debt. So what's your level of concern right now? And would you consider the Evergrande Group issue a sort of a warning signal?
About the United States? No. Corporate defaults are very low in the United States right now. Corporate leverage built up over the course of the long expansion that ended with the pandemic. We were very concerned in the last year or so. We were concerned in the last year or so, and then I'd say very concerned at the beginning of the pandemic that if you've got a highly leveraged company and your revenue stops for an uncertain period, as things happened at the beginning of the crisis, we were very concerned that there would be a wave of defaults. Didn't happen, potentially, to a significant extent because of the CARES Act and the response that we undertook and all that. It was a much stronger response than we've ever had. And I think for whatever reason now you have very, very low default rates now among corporate debt. The Evergrande situation, it seems very particular to China, which has very high debt for an emerging market economy, really the highest that any emerging market economy has had, and the government has been working to get that under control. This is part of that effort. The government put new strictures in place for highly leveraged companies, and Evergrande is dealing with those strictures, and it's something they're managing. In terms of the implications for us, there's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed, but that you would worry that it would affect global financial conditions through confidence channels and that kind of thing. But I wouldn't draw a parallel to the United States corporate sector.
Thank you. We'll go to Brian Chung.
Hi, Chairman Powell. Just wondering if you could give us an update on whether or not you've had conversations with the White House about a possible reappointment, and then whether or not you would like to be reappointed as this chatter kind of builds up. Thanks.
I think the phrase goes, I have nothing for you on that today. Sorry. I'm focused on doing my job. Focused on doing my job every day for the American people, and I don't have any comment on that, Brian.
Sorry about that. Let's go to Greg Robb.
Thanks for taking my question, Chair Powell. I was wondering if in your discussion about the tapering that you said that officials think it's appropriate to end around the middle of the year, if there was any discussion about what happens to the balance sheet then. I've heard some Fed officials say that they would shrink the balance sheet. Was that discussed, and what's your stance on shrinking the balance sheet? Thanks.
So my thinking on this has been, let's get through the taper decision, and then let's turn to those issues. There are a number of related issues. You mentioned one, Greg, but and which you need to start to think about, and we'll do that. But we want to get through this taper decision and then turn to those issues, rather than start thinking about them now and having the minutes discuss them and get people thinking that we are focused on those issues, because we're really not. And we do have the experience of what we did last time. We've watched other countries and what they've done, so I think we'll be able to get to sensible decisions fairly expeditiously when it's time, but it's just not time yet in my thinking.
Thank you.
Thank you. Let's go to Scott Horsley.
Thank you, Mr. Chairman. You talked a little bit about inflation expectations, and there does seem to be something of a divide between market expectations and the views of professional economists, which are pretty much in line with the FOMC members, and lay people's expectations, at least as reflected in the recent New York Fed survey. How much weight do you put on lay people's expectations, and what do you think accounts for that divide?
So let's just take the household surveys generally. The New York Fed survey, let me talk about that specifically, and this is from the New York Fed. It's only an 8-year-old survey, and it does seem as though they're looking 3 years out, and it seems like there's a high correlation between 3 year and 1 year. For the most part, surveys are showing that households expect higher inflation in the near term, but not in the longer term. And that's also what expectations are showing. So there are many, many different inflation measures, of course, and that's why we have this thing called the CIE, which is it's an index of it's market-based measures, it's professional forecasters, and it's household surveys. And you just put them all, it's not, it doesn't have a lot of grand theory about it. You put them all in, and you measure the change. So you should be, and also you measure things like the dispersion and that sort of thing. So you can look at all of that, and it tells a story of inflation expectations moving up. Many of the different measures will also show inflation expectations moving back up to where they were in, say, 2013, which was before the drop in inflation expectations broadly happened in 14 and 15, around then. So that's not a troubling thing, but inflation expectations are terribly important. We spend a lot of time watching them, and if we did see them moving up in a troubling way and running persistently above levels that are really consistent with our mandate, then we would certainly react to that. But we don't really see that now. We see more of a moderate increase that is in the first part of which is welcome, and because inflation expectations had drifted down, and it was good to see them get back up a bit, but again, we watch carefully.
Thank you. Let's go to Heather Scott.
Hi, sorry. You caught me off guard. Thank you, Chair Powell, for taking my question. I really appreciate it. Again, on the taper timing, you say it's going to last until the middle of next year, but with your concerns about the potential for upside risks to inflation, would you think you might need to have liftoff happen before you finish the tapering?
That's not my expectation. Of course, we can always. We haven't decided to taper yet, and we haven't decided the pace yet. So it's not my expectation that we would have to. We can certainly speed up or slow down the taper if it becomes appropriate, though. Absolutely. In fact, back in 2013 when we tapered, we always said we weren't on a preset course. I think this will be a shorter period. The economy is much farther along than it was when we tapered in 2013. So it makes sense to allow the runoff to happen. It's a very gradual taper. It will be when we agree on it. But we certainly have the freedom to either speed it up or slow it down if that becomes appropriate.
But you wouldn't expect rate liftoff to happen until you're finished with that process?
It wouldn't. No, because when you're as long as you're buying assets, you're adding accommodation, and it wouldn't make any sense to, then lift off. I mean, what you would do is you'd speed up the taper. I think if that were the situation you're in. We don't expect to be in that situation, but I do think it would be wiser at that point to go ahead and speed up the taper, just because the two are then working in the same direction.
Great, thank you.
Thank you.
Okay, for the last question, we'll go to Jeff Cox.
Thank you, Mr. Chairman, for taking the question. I just wanted to check in with you to see if you have an update at all on the efforts from the Fed to develop a central bank digital currency. I believe that the report was supposed to come this summer, and indications that it's going to come this month. But the drumbeat seems to be kind of getting louder to see where the Fed's heading on this, and just wondering if you can provide some update there.
Sure, I'd be glad to. So we think it's really important that the central bank maintain a stable currency and payment system for the public's benefit. That's one of our jobs. We also live in a time of transformational innovation around digital payments, and we need to make sure that the Fed is able to continue to deliver to the public a stable and trustworthy currency and payment system. So there's extensive private innovation, a lot of which is taking place outside the regulatory perimeter, and innovation is fantastic. Our economy runs on innovation. But where the public's money is concerned, we need to make sure that appropriate regulatory protections are in place. And today, they really are not in some cases. So with that in mind, and with the creation of myriad private currencies and currency-like products, we're working proactively to evaluate whether to issue a CBDC, and if so, in what form. We have two broad work streams, one of which is really technology, both at the board and in the Federal Reserve Bank of Boston's work with MIT. The other of which is to identify, scope out, deal with, analyze the various public policy issues. As you mentioned, we do intend to publish a discussion paper soon that will be the basis for a period of public engagement with many different groups, including elected officials around these issues. We think it's our obligation to do the work both on technology and public policy to form a basis for making an informed decision. The ultimate test will apply when assessing a central bank digital currency and other digital innovations is, are there clear and tangible benefits that outweigh any costs and risks? We're also, as you know, investing heavily right now in building a new settlement system for instant payments in the U.S. It'll be the first such major expansion of our core payment system since the 1970s. We found the case for this quite compelling. For consumers, businesses, and just ensuring that all financial institutions have access to the payment system. So bottom line, we haven't made a decision about the CBDC, but we will be issuing a discussion paper soon in order to form the basis of this public interaction that we'll have. Thank you very much.
If I can have a quick, can I get a quick follow on that? Thank you. I'm just wondering if you're, okay, are you concerned at all with kind of falling behind in the global race for digital currencies?
I think it's important that we get to a place where we can make an informed decision about this and do so expeditiously. I don't think we're behind. I think it's more important to do this right than to do it fast. We are the world's reserve currency. And I think we're in a good place to make that analysis and make that decision. By the way, which will be a government-wide decision. We would do this. We would have to have a meeting of the minds with the administration, and also probably with Congress. We would really like to have broad support for this. It's a very important innovation, and I think we would need that to go ahead, and that's the process we're engaged in. Thanks very much.
Thank you.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress in vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic have shown improvement, but have not fully recovered. Household spending is rising at an especially rapid pace, boosted by the ongoing reopening of the economy and ongoing policy support. The housing sector remains very strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where worldwide shortages of semiconductors have sharply curtailed production so far this year. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and employment rose 850,000 in June, with the leisure and hospitality sector continuing to post notable gains. Nonetheless, the labor market has a ways to go. The unemployment rate in June was 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months, leading to strong gains in employment. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower-wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably and will likely remain elevated in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger than anticipated, but as these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal. Very low readings from early in the pandemic, as well as the pass-through of past increases in oil prices to consumer energy prices, also contribute to the increase, although these base effects and energy effects are receding. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of long-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of policy. The effects of the pandemic on the economy have continued to diminish, but risks to the economic outlook remain. Progress on vaccinations has limited the spread of COVID-19. However, the pace of vaccinations has slowed, and the Delta strain of the virus is spreading quickly in some areas. Continued progress on vaccinations would support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, With inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency MBS by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change. Participants expect that the economy will continue to move toward our standard of substantial further progress. In coming meetings, the committee will again assess the economy's progress toward our goals, and the timing of any change in the pace of our asset purchases will depend on the incoming data. As we've said, we will provide advance notice before making any changes to our purchases. On a final note, we announced the establishment of 2 standing repo facilities, a domestic one for primary dealers and additional banks, and another for foreign and international monetary authorities. These facilities will serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Thank you. Let's go to Steve Leisman with CNBC.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, I don't know, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2% on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation, there's wages, there's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So there isn't. I can't give you a set of numbers, for example, a numerical threshold like we used for a time back in 2012, I guess it was. We didn't do that here. What we said was substantial further progress toward our goals, and what we said was we would keep, effectively, we would give advance warning as we, and more and more clarity as we move forward. And that's what we're going to try to do. So what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're some way away from having had substantial further progress with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
if I could follow up, you talked about one side of the equation. You didn't, does it mean you feel like you've reached your goal when it comes to the inflation side? Thank you.
So inflation is running well above our 2% objective and has been for a few months and is expected to run up certainly above our objective for a few months before we believe it'll move back down toward our objective. The question whether we've met that objective formally is really one for the committee to make. I can't do that by myself, but it's clear that at this time inflation is actually running above 2% and again has been and will be, at least we expect it will in coming months before returning down toward our target.
Thank you. And Saphir with Reuters.
Hello, can you hear me? Hello, can you hear me? I'm sorry.
Yes, we can hear you.
I apologize. I just to follow up on the question, I want to ask, is it correct to see this as the start of the advance notice process? Before a taper, and also, can you speak to how the recent surge in COVID factors into your thinking on the taper? Thanks.
So as you know, we're in a process now where what we said is that as at this meeting and in coming meetings, we're going to be continuing to assess the economy's progress toward our goals and give advance notice. We'll be try to provide additional clarity about our thinking, both in the post-meeting statement and in the minutes and in the public comments that people make. Our approach here has been to be as transparent as we can. We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there. So that's what I would say. In terms of COVID and the Delta strain, I'll say a couple things. Of course, it will have significant health consequences for many, and we need to keep that in mind before we mention and move to the economic questions. This is rising cases in a number of parts of the country, and some forecasts are for them to rise quite significantly. We'll see. What we've seen, though, is with successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave, and we will see whether that is the case with the Delta variety. But it's certainly not an unreasonable expectation. So it certainly is plausible that people would pull back from some activities because of the risk of infection, dining out, traveling. Some schools might not reopen. We may see economic effects from some of that, or it might weigh on the return to the labor market. Some people might choose. Again, we don't have a strong sense of how that might work out, so we'll just be monitoring it carefully.
Thank you. We'll go to Nick Timros at the Wall Street Journal.
Hi, Chair Powell. Nick Timros at the Wall Street Journal. In your opening statements in March and April, you noted that a transitory rise in inflation above 2% this year would not meet the threshold of moderately exceeding 2% for some time. And I noticed you didn't repeat that qualification last month or today. And so in your view, has the rise in inflation this year met the threshold of moderately exceeding 2% for some time?
That would, again, be a question for the committee, but I would really say the guidance that you're talking about is really the guidance to do with liftoff, right? That's what the guidance is for liftoff. We had to have labor market conditions consistent with full employment, inflation at 2% and on track to run moderately above 2% for some time. It really isn't relevant now because we're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. So when we get to that question, when we start to get to the question of liftoff, which we are not at all at now or near now, that's when we'll ask that question. That is when that will become a real question for us.
Great, thank you. Gina Smialek at the New York Times.
Hi, Chair Powell. Thank you for taking our questions. I wonder if you could talk a little bit about reacting. Does that affect how you're thinking about tapering? Does it affect how you're thinking about, potential liftoff down the road? And if you could just talk a little bit about that.
Gina, I'm sorry, for the first 15 seconds of your question, you froze. Could you say that again? I apologize.
Oh, yeah, no, sorry. Yeah, so I was wondering if you could talk a little bit about how the divergence in global growth and the sort of multi-speed recovery we're seeing around the world impacts how the Fed thinks about its policies. So do you take into account that sort of multi-speed recovery when you're thinking about tapering QE, and do you take it into account when you're thinking about liftoff?
Thanks. So it's an important feature of this recovery is how uneven it is, and in many cases it's related to the fact that some countries have had little in the way of access to vaccines, and so they're seeing significant outbreaks and it's weighing on economic activity, whereas other countries, such as the United States in particular, are having a very strong rebound. And now Europe is having a stronger rebound as well. So it's a feature of our economy. Now, how does it affect our policy? In a couple of ways, potentially. One just is that in general, economies and through financial markets and through trade are deeply interconnected now. And so a stronger global economy will lead to more U.S. exports, and that'll help economic activity. To the extent the global economy is weak and the United States is strong, we'll wind up exporting some of our demand through imports rather than having a lot of exports. That's one way. Another way, though, is more on the risk side, and that is, as long as COVID is running loose out there, as long as there's time and space for the development of new strains, no one's really finally safe. These strains, there's no reason they just can't keep coming, and one more powerful than the next. We don't know that, but that's certainly a plausible outcome. Now, as vaccinations rise, we can nonetheless get back to our economic activity. But it is both the right thing to do and very much in our interest to make sure that vaccination happens broadly around the world, just for that reason.
Thank you. James at the FT.
Thank you very much. Chair Powell, how would you describe the risk to the outlook on inflation at the moment after the last data came out higher than expected? Do you believe the risks are tilted to the upside? And does the committee share that view, or are they in balance? Are you still worried that there could be a hit to demand from the Delta variant that could tilt them sort of to the downside again? If you could give us a sense of that, that would be very helpful.
Sure, I'd be glad to. So if you look at the most recent inflation report, what you see is that it came in significantly higher than expected, but essentially all of the overshoot can be tied to a handful of categories. It isn't the kind of inflation that's spread broadly across the economy. It's new, used, and rental cars, it's airplane tickets, it's hotels, and it's a couple of other things. And each of those has a story attached to it that is really about the reopening of the economy. So we look at that and we think that those are temporary things because the supply side will respond, the economy will adapt. We have a very adaptable, flexible economy and labor market, and it's a real asset that we have. And so we think that inflation should move down over time. Now, we don't have much confidence, let's say, in the timing of that or the size of the effects in the near term. I would say in the near term that the risks to inflation are probably to the upside. I have some confidence in the medium term that inflation will move back down. Again, it's hard to say when that will be. I will say though that inflation is half of our mandate, price stability is half of our mandate, and if we were to see inflation moving up to levels persistently that were above, significantly, materially above our goal, and particularly if inflation expectations were to move up, we would use our tools to guide inflation back down to 2%. So we won't have an extended period of high inflation. We think that some of it will fall away naturally as the process of reopening the economy moves through, and it could take some time. In any case, we will use our tools over time as appropriate to make sure that we do have inflation that averages 2% over time.
Thank you. Victoria at Political.
Hi, Mr. Chairman. So bond market pricing seems to suggest that investors think the Fed might eventually over-tighten. So my question is, do you think that markets have bought into the central bank's new framework, and how do you balance that with managing inflation concerns?
Well, so in terms of what's been happening in bond markets, I don't think there's a real consensus on what explains the moves between the last meeting and this meeting. We've seen long-term yields go down significantly. Some of it is a fall in real yields, which may have been connected to, some speculate, connected to sentiment around the spread of the Delta variant and concern about growth. There was also some decline in inflation and compensation, which is significantly reversed. And there are also so-called technical factors, which is where you put things that you can't quite explain. So I don't see in any of that there is really anything that challenges the credibility of our framework, if that's really your question. We are committed to achieving 2% average inflation over time. What we said was that, in particular, when we see a very strong labor market, high levels of employment, low levels of unemployment, that won't be enough for us to raise interest rates until we see some inflation. Of course, what we have today is kind of the opposite. We've got 7 or 8 million people, fewer people at work than were at work before the pandemic. So we're a ways away from full maximum employment, but we have high inflation. So it's kind of the opposite case, and we have to deal with that. Any central bank has to deal with that by looking at the inflation and asking whether it is broad-based and likely to be persistent, and whether inflation expectations are implicated in a way that could cause them to rise. So we're monitoring that very carefully, and we're prepared to use our tools as appropriate. But again, I think our framework is pretty well understood, and I think the real test of it will be down the road when it's time to think about raising interest rates and how we assess that set of issues.
Thank you. We'll go to Rich at Bloomberg.
Thanks very much, Michelle. Chairman Powell, you just alluded to the fact that you're prepared to use your tools to slow the economy down if need be, if inflation looks like it's getting out of control. I want to just try to understand that in the context of the framework and the forward guidance. Does that mean you'd be